Hi guys, so our classes start from now. To break the ice, can each of you have a short introduction about who you are and what's the purpose of your business? Just 1 minute introduction. Anyone first?
Thomas, could you please go on by the list?
Okay. First one is Nudix.
Yes. Hello. I represent Nudix. Nudix is an all-in-one Web3 platform and studio like Steam plus Kickstarter for adult games. We solve block payments, lack of funding, and safe investing in a 20 billion plus underserved market.
Yeah, that's great to know. And next, Xwise. Anyone? So I'm gonna move to the next project is Predict Market. Anyone? Hachiverse.
Hey guys, how you doing? It's Saul from Hachiverse. We are a Web3 decentralized IP. We're a creature collectible IP, kind of like Pokemon, with fractionalized tokenized share. So we've got the Hatch token, which basically works as a share of the IP and some of the licensing rights. At the moment, we have kind of like collaborative ecosystem, roughly 60 plus builders across 9 projects, with hopefully a game or 2 coming out over the next couple of weeks. So yeah, nice to see you all again today.
Thank you. Very insightful information. Next is BitDance.
Hello. We are BitDance. Thank you for having me. BitDance is a decentralized physical infrastructure network, and is committed to building an open data infra for personalized AI agents with privacy preserving by leveraging trust execution environments, zero knowledge proofs, and smart contracts. It can be widely used in the fields of healthcare, finance, education, etc. That's all. Thank you very much.
Yeah. Thank you. TokenTales. Bogowi. Aroya. Okay. Lattice Network. Suster.
Yes, I'm here.
Yeah.
Well, I'm Sebastian from Schuster. Schuster is a next generation decentralized storage powered by Lattice technology. Basically, it is a new type of network that is able to handle mutable and immutable data, and it also able to solve the problem of keeping data long term without using binning services for users and also for businesses.
Thank you. Next is Cubane. Pata Protocol. Polycruz.
Hello, hi everyone. Mitesh here from Polycruz. We are building the AI native no-code platform where all the creator and the enterprise, they can able to build, launch and scale effortlessly in Polycruz. In Web3, we are having a 2 main function, backend B2B, and the front end we have a ready-made application with the domain wise. Whether all the, a client, they can just browse all the plugin with the domain wise application, whether it's an NFT, RWA, gaming, DeFi, or any other domain that we are offering right now. So we have more than 6+ beta application live right now. So about to launch first application, which is a Polycruz AI Studio. So this is all update. Thank you.
Yeah, thank you. Gogo Cash.
Yep. Yeah, Google Cash
I'm from for the founder of the Google Cash, which is a shopping tool and platform that integrate with 70 plus merchant partners. So we are focusing on the Southeast Asia e-commerce market with the Web3 to provide a cashback as a stable coin here. Yep, thank you.
Thank you. Legend of Hertz.
This is Ahmed from Legend of Hearts. Legend of Hearts is a multiplayer cooperative action adventure game, such as It Takes Two on-chain. The players can explore like different obstacles together. They can like convert emotions. They can defeat the villain, and they can send NFT gifts utilizing our account abstraction technology on top of social media. We are proud that the game is completely family friendly, anti-violent, anti-nudity, and anti-gambling. Thank you.
Thank you. Next, QSTN. Vaycraft. Next, Agis Finance.
Hi, I'm Wing from Agis Finance. So what we do is that we tokenize stocks so that investor can get liquidity and they can spend with their Visa cards and also earn yield. All of this without actually selling their assets, right? So it's pretty much like converting your stock portfolio into a liquid account where you can use it anytime while it continues to generate things yield. So if you think that we can collaborate in any of this area, right, feel free to reach out to me. Right, that's it. Thank you.
Yeah, thank you. And the last one is Yamada. Okay, so we already take the attendance, and now
Hi Thomas, could you please call attendance again for the one who haven't got chance to present?
I joined late, guys. Sorry, Brendan Yamada.
Okay, Yamada.
Hi. Yeah, so I'm Brendan, a co-founder of Yamada, and Yamada is a DeFi super app offering a centralized grade of performance to all markets on chain. We offer spot, perps, options, prediction markets, and vaults all in one place and all on chain using a hybrid architecture.
Thank you.
Nice.
Now I'm gonna call once again, the projects who didn't join in yet. First one is Predict Our Market. XWise.
Hi, we are here. Hi everyone, I'm Tom West from XY team, and we are building an all-in-one platform, including a social network, e-commerce, smart wallet, and many mini apps. That's a foundation for the future RWA tokenization, linking digital assets with real world value. Thanks everyone.
Thank you. TokenTales. Next, Bogowi. Next, Auragel. Porta Protocol. QSTN. Vaycraft. And that's it. So today we have the participation of a speaker about how market makers work. Jack Cesar will be our speaker today. He's a managing director at Quantix Capital. Jack, can you?
Yeah. Hey everyone, how's everyone doing? Yeah, if you don't mind, Thomas, I'll just kind of hop right into it. So I guess I'll take that as a yes. Hey everyone, my name is Jake Seltzer. I'm the head of quantitative strategies and managing director of Quantix Capital. We are a liquid hedge fund based out of the UAE with offices in Panama, Korea, Singapore. We've been in the space since 2017. We've backed products such as Revolut, Gala, Tezos, Telos. We were part of last cycle's incubation process where we worked hand in hand with a number of products. Eric and I are close friends, and so he asked me to come and teach the market maker class again. I guess they liked the way I did it the first time, so back to do it once more. So today's class is focused on market maker, how it works, choosing the right one for you, how liquidity provisioning works, predatory signs of market making, basically everything there is to know when coming to market with your token and understanding how token products work. You guys also, if you have the chance, could take a look at our token. We're currently a top 300 token. Our product is called Quantix AI. We started our token price at 22 cents and are over $90. So have some pretty good insights on how to run token markets, market makers and liquidity providers for some of the top tokens of the market. So just going to give you guys some insights on how anything works. If at any point, I like to try to make these classes like pretty discussion friendly. So at any point, if anybody has any questions, just I can't really see the actual chat for hands up. So you can just feel free to unmute yourself and ask questions wherever you see fit. So again, I like to keep it kind of discussion open rather than me just talking points. So today's class, we'll focus on a few things, right? Like what is market making, the power of your tokenomics, cracking the code of order books, liquidity and price stability, the metrics that exchanges expect you to maintain, real world case studies. We'll check out some wins and some wrecks. And then we'll also take a look at some interactive Q&A discussions after we kind of finish. So one thing that I kind of want to say here that we'll get into for a few different points of this class, market making is fully encompassing. And if you don't have a successful market making strategy, your product will fail before you launch. So market making is not just when your token comes to market and you put some liquidity into your market and you're managing your buy and sells. Market making is much more than that, right? It's the power of your tokenomics and understanding how to put together a tokenomics that's clear, to making a product that works and is sustainable. It's managing your metrics, right? Like we've seen a lot of products being delisted from a lot of exchanges. So how do I manage the expectations and the metrics of the exchanges? So market making is within itself pretty much a full-time job. And finding the right market maker that fits to the product that you're building and fits your token and your ecosystem is really important. So let's kind of get into it, right? What is a market maker? So a market maker can be a liquidity provider, right? So someone who continuously quotes buys and sells prices, keep your markets active and accessible, stands really ready on both sides to trade at any time. Liquidity provider has also within the last time turned into a little bit of a different meaning. So really there's two sides to a market maker. You have a retainer-based market maker and you have what's called a loan-based market maker. Retainer-based market maker is where you basically pay a market maker or like a trading firm to maintain your markets. Within that model, you have to actually put the liquidity yourself. And so you're constantly providing the USDT to balance out. Now, one of the really good parts about that is that you get to benefit directly from your charts. On the other hand is what's called a loan-based market maker. And on a loan-based market maker, where you're probably hearing the word liquidity provider, is companies like Wintermute, GSR. I'm sure a lot of you guys are familiar with what happened on the 10/10 event. Essentially, you have what's called a loan-based MM. You basically feed them tokens before you're launched. That market maker will then turn around and go into a strategy where they will then basically put the liquidity and USDT into your market, and they'll actually control the price fluctuation. Moving a little bit further into that, we have spread reducer. In all of your order books, you have a spread to maintain. So they will narrow the bid gap. They'll ensure that the pricing is fair for all of your organic trading activity, and they'll minimize the slippage and the volatility. Your market maker should also be someone who's a market stabilizer. This is someone who adds depth to your order book. This is someone who prevents wild swings and price swings and flash crashes. And also it ensures that it's a smooth trading experience for both your institutional players and your retail users. Lastly, a market maker, this is not something that they'll typically advertise, but they're very much so a confidence builder, right? You have to make your token feel alive. If you have stagnant charts, if you have stagnant order books, organic and incentivized traders will not come to your token to trade. And so we have what's inside the industry, what we call will make your token feel alive. This attracts traders, investors, and exchanges to want to list you. It also builds trust through the consistency and activity of the volume. One thing that I want to retouch on this slide is understanding the difference between loan-based and retainer-based, because it's the biggest question that you're going to face when you choose your market maker. If you don't have the liquidity to substantiate, let's say you're going to raise capital right now, and within your pre-sale process, you only raised $100,000, but your target was $500,000. And so let's say your listing cost is $60,000, and now you don't really have the capital to keep a retainer-based market maker and to put your own liquidity. It's obviously within your best interest to explore a loan-based market maker. However, understanding what loan-based market makers do is really important. Loan-based market makers take all the upside out of your initial launch, meaning when your token comes to market and you receive that original $50,000 to $200,000 in buy pressure, your market maker is going to take that liquidity and you're not going to end up with that. When you give tokens to a loan-based market maker, you sign basically an agreement at a strike price. And so the market maker is only responsible for paying you at that price on the token warrant. Now, a retainer-based is typically a little bit more expensive, but gives you much more control of your market. So a retainer-based market maker will typically charge something between $2,500 to $10,000 a month, depending on the boutique, the strategy, and things that you're going to ask them to do and the markets that you're going to ask them to trade. You're also going to be responsible for putting the initial liquidity of the order book. We're going to touch on the market, what you're required to have in your market making accounts when you do your initial listing, but essentially those are the two key differences. It's really important to understand this because many projects that have unsuccessful launches or many projects that go down right away post their launch are projects that use loan-based market makers. A lot of the really successful projects that you're seeing in the market are using retainer-based. Why? Because there's much less sell pressure from the original token sort of spend. So we'll get a little bit more into that, but it's really key to understand that. Now, market making in crypto is basically a trading firm, right? So they'll have automated trading systems. Essentially, they're going to put bots into your markets that will generate volume at a consistent time. Why do they do this? It's basically to reduce latency and human error within these volatile markets, much like we're kind of seeing now. Also, it prevents illiquidity, right? Again, we kind of talked about having stagnant markets, frozen order books. Essentially, for retaining sort of traders and building confidence, you need to maintain your liquidity. Builds healthy trading environments. I think that one's pretty self-explanatory. The liquidity encourages the new participants to enter, keeps the spreads tight, and keeps the prices honest, right? We don't really want to encourage any sort of pump and dump or price manipulation. And so your market maker should be really important and really key in helping you maintain a really healthy and what we call organic market. Now, this is one thing that a lot of market makers don't typically do that I think is really important that every market maker should do. And when choosing your market maker, it's really important that you find one that does. A market maker should also align with you and work with you on things such as your supply schedule, your unlocks, your exchange requirements, and they should also help to bridge your token design with real-world execution. So essentially what we kind of mean by that is if you're a project and you raised $100,000 at, say, 10 cents, and you're then coming to the market with a public price of 20 cents, you're going to face $200,000 of sell pressure for $100,000 of liquidity. So your market maker firm should make recommendations to you like, hey, perhaps we shouldn't launch at 20 cents. We should launch at 12 cents. And then there'll be much less sell pressure. Or, hey, potentially we should do a public sale 1, a public sale 2, and then potentially do this type of strategy. So your market maker should really work with you to identify your supply schedules and your tokenomics so that A, your token has a better launch rate, but also B, as your token is being vested out and given out to investors and supporters and whatever it is, whoever invested in your token during those supply schedules, your market maker has to know to thin out your liquidity, right? Or how to embrace those potential sell pressures. Because if, for example, I have 50,000 in my order book and I know that $70,000 of sell pressure is coming, all my liquidity will get eaten. So it's really important for your market maker to work with you on your tokenomics strategy. So that kind of leads us into the next slide, which is why tokenomics matter. Tokenomics is basically the DNA of your token. If your token is going to survive long term, which we see a lot of tokens not really seeing kind of positive right now, if your token wants to survive long term, you really kind of have to have 3 things. You need to define how your token will flow, circulate, and gain value. If you're launching a token to simply launch a token and you think that that's going to bring you capital, you're in for a tough time. Your product has to be revenue driving and the token plays a role within your ecosystem. The token flow needs to be distributed well in the fact of how your token is going to circulate throughout your ecosystem and how your token is going to then work its way to the users and from the users to the treasury and from the treasury to the investors. It all needs to kind of coincide with one another. The tokenomics also matters because it drives long-term holder conviction and trust. When I'm buying a new token or I'm supporting a token through our incubator or we're investing in different token strategies, one thing that we look for is, has the foundation put together a solid strategy that makes this token work for 2-3 years? Now, if you're launching a meme token, that's always not necessarily the goal, which is why you see huge amounts of token unlocks early, but typically within really good strategies, there usually is some sort of 24 to 36 month hold. Now, a lot of teams last year, the year before, and the year before that were trying to get away with like, oh, well, it's 1,000-year lock in the pool, and then there's liquidity locked in the pool. No one is really falling for that. Creating a sustainable real tokenomics matters, and it will drive institutional capital to your product. If you create a bad tokenomic, and again, tokenomics are difficult. Sometimes tokenomics can take 2-3 months to strategize, right? A bad tokenomic will pretty much 99.9% of the time lead to price crashes and short-lived hype. Understanding crypto is a hype cycle based economy, and if you have major price action incidents and you have crash incidences, your community will go up in arms, and it makes it hard to build great products because you're constantly hampered and negated by your community's negative sentiment and FUD. And I'm sure Eric can probably talk about that from 100 tokens who've come through this incubator and quickly rushed to market that shouldn't have, right? But it's something that's really important and something that you really need to look at when you're kind of designing your tokenomic. Let's talk a little bit about your pre-sale design. When you're doing your pre-sale, we always try to encourage products to limit the amount of funding that they take in a pre-sale. Though it's really exciting to try to take as much money as possible during this time, you have to understand that not all capital is good capital. So when you're designing your tokenomics and you're designing your pre-sale, make sure you have a clear use of funds, right? Like, how is the liquidity going to be divided? How are we going to utilize the capital that we're taking in right now? And does it make sense to take this capital in? You also want to put cap limits to avoid any dumping pressure. If, for example, you're raising at 10 cents and you're coming to market at 20 cents, people are going to automatically 2x. Even if your community has strong conviction and they believe in the product, most people understand how tokens work at this point, and will immediately take profit and buy back when your token goes lower. And essentially, they will double the amount of token holdings, or they'll take back their initial capital and then they'll hold whatever profit, right? So you have to be careful and you have to limit the potential like future dump in the future. Vesting schedules are really important for early buyers. If you have institutional investors, work out positive cliffs and vesting schedules that allows you to limit the potential exposure that you have, right? So a lot of products that we're seeing now are doing 6-month cliffs, 12-month vests. Some people are doing 10-month cliffs, 10-month vests. Like, work out something that aligns with your token strategy to where your product is revenue based, that you could potentially cover any of that future sell pressure, right? Because the capital that you're raising in the pre-sale is designed to make your product grow and is designed to bring revenue to the ecosystem. And then obviously, kind of what we were talking about before, you need to align your pricing between the pre-sale and the public launch. Does anybody have any questions before on anything that we've talked about? Because I know it's a lot of information to digest, so I'll kind of give a quick stop. Does anyone have any questions? All right, cool. Easy crowd. We'll keep going. Let's talk a little bit about liquidity pools. So liquidity pools are the amount of capital that exists within your order book. So if, for example, you have, say, $2,000 in your liquidity, usually it's really easy for bots to and manipulate, and the volatility of your token will be quite high. If you have too much in your pool, you can run the risk, especially on the DEXs, more than the SEC side. But if you put too much liquidity in your pool, you're opening yourself for opportunities to get sniped. So we have what's called just right. So basically, it's where buyers and organic liquidity could come in for a smooth entry, and it also allows for exit of buyers and sellers if, say, they choose to kind of move on from the token or sell or day trade or whatever it is, right? So liquidity pools are really important. Different exchanges have different requirements for different liquidity. So, for example, when you list on MEXC, MEXC, depending on the listing price, let's say they're $30K in tokens, $30K USDT. Some products pay all USDT, some products pay all tokens. Let's say the price of MEXC is $60K. If you give MEXC $60K and $30K of that as tokens, MEXC requires you to put, let's say, somewhere between $30 to $50K USDT in your market. That $30 to $50K USDT will deplete pretty quickly. Now, if you're listing on something like CoinStore, most of the time they don't require a huge listing fee. You can list for 5, 10,000, and typically you do that in USDT, and you can put a smaller liquidity pool like 10,000. So it's really important to know how to adjust your liquidity pools based off of the exchange that you're listing on. And liquidity pool management is not a one-time thing. Liquidity pool management is something that you're going to have to constantly do. On days where you're facing heavy sell pressure, you're going to have to do what's called a top-up, where you put additional USDT or USDC or BTC or ETH, depending on the pair that you're running, into your market. There might be days where you'll see a ton of organic liquidity come into your market, and you'll want to do potentially like a liquidation to where you're going to build your treasury. So understanding how to manage your liquidity pools and how to run your liquidity pools and how to put the initial capital in them is really important. Sorry, I think I heard a hand go up. Yeah, what's going on, Mitesh?
Hi, Jack. Just wanted to ask about the liquidity. Example, a listed Maxi asking the 10K, that the liquidity providing from the startup. So my understanding, is it like we have to maintain the higher liquidity to that allow that bigger investor to jump in that token sale buying side, or the lower liquidity have how does it the chance of the the more that a higher well investors or bigger investors they can come and jump in with the lower liquidity side?
Yeah, so it's a great question, Mitesh. So I'll kind of talk about two things here. So when you do your initial listing on, say, something like MEXC, right, and let's assume that you're going to pay the 60K listing fee in all USDT. So let's say you're not going to face any sell pressure from MEXC. When you put in that initial 50K is what's called a listing requirement. It's an exchange metric that you have to do before you typically launch. Now, sometimes they allow you to break that into two different tranches where you can put like 25K USDT and 25K of your token. It's important that your market maker utilizes that liquidity properly. So like, for example, in your +2 and your -2 side, which we'll get into here in a few minutes, but it's important that on both sides of the order book, there's healthy markets. So let's say, for example, on your buy side, you're looking to sell more tokens. You would maybe put $5,000 to $7,000 of sell pressure, right, within your order book yourself, to where if organic buyers wanted to come in and buy up tokens, there's a healthy market. Now, you might want to absorb less tokens. So you maybe want to put $4,000 or $3,000 on your buy side. So if users come in to sell, you don't have to absorb so much of the sell pressure, but you keep and maintain your spreads tight. So like, that's kind of what's important about managing your liquidity pools. And your liquidity pools are what drives a lot of confidence, right? Like, if I go to a token and I see that there's $150 of